Hello there. Welcome to the third lecture of the day trading model. This lecture is going to be about time. Before we start this lecture, I must first give you a risk disclaimer. I am not a financial advisor. Everything that I say and share within this lecture is meant purely for educational and/or entertainment purposes only. If you want to read the full risk disclaimer that you have agreed upon when subscribing to the mentorship or joining the ones that know, you need to go to our website and you will be able to read it there. Before you watch this lecture, I must share something with you, and that's the following. You need to know how to determine the order flow. If you do not know how to determine order flow, this lecture will do you no good because it's above your current level of understanding. Next to that, you need to know how to determine the draw on liquidity. Again, if you do not know how to determine the draw on liquidity, this lecture will again be of no benefit to you just yet. You need to know how a true market maker model functions and its characteristics, because again, if you do not understand the full inners and outers of the market maker models, this lecture will do you no good, because time is by far the most advanced concept to even discuss, but also to learn about. This is not me saying to you, don't watch this lecture. Of course, you should definitely watch it, but first make sure that you have these three things noted correctly within your notes and that you have studied them at least and that you have followed on through the homework assignments that have been provided to you during the past two lectures. This is me as a mentor guiding you in the best manner possible. And this is not me saying, okay, don't watch this. This is just me giving you reasonable advice and saying, okay, you should first do this, and then when you understand that, come here. So let us take a look at the table of contents for this lecture. This lecture is going to be the longest lecture by far so far of the model series. The reason why this will be the longest lecture is because, again, time is the most advanced concept that you can discuss. And therefore, I want to go in great detail with you with sharing how I interpret time and utilize it within my own trading. So, first of all, we're going to take a look at the sessions of interest. These sessions are the following. First of all, we're going to take a look at the London session and the characteristics that are present during London. After that, we're going to take a look at the morning session. And finally, we're going to take a look at the afternoon session. As you may notice, we're not going to look at the Asia session because, in my opinion, Asia is not a great session to trade. So let's begin with the sessions of interest. For Forex, so for trading, for example, Euro or GU, your focus should be on the London and morning session. The afternoon session can be skipped for Forex. The reason why this is my advice is because the London and morning session usually provide the most volatility for the main markets of interest. And therefore, I would always look for setups in Forex during the London and morning session. For the index futures, I would focus on the London, morning, and afternoon session. However, here comes something very important. Please do not try and trade every session. You should pick the session or sessions that suit you best and let go of the others. If you notice that, for example, the London session fits best in your daily schedule, due to, for example, work or due to a personal life, etc., then your focus should just be on the London session and you should ignore the morning and afternoon session. If due to your personal routine, the morning session fits you best, focus on the morning session and let go of the London and afternoon session. If, for example, the afternoon session fits your schedule best, focus on the afternoon session and let go of the London and morning session. If you want to take it a step further and you are full time, then I would suggest every single index futures trader to look both at the morning session and the afternoon session. During this lecture, I will share very specific time windows during which we will be looking at the morning and or afternoon session. We will not be stuck to our charts all day because that's not effective trading. Effective trading is the following. You know when and where you're looking for very specific things to occur. You're not looking for, oh, I see a breaker setup, therefore I'm going to trade this breaker setup. No, that breaker setup will only be valid during the right period of time at the right point of interest. And that's where I'm trying to guide you towards. Here we can see the sessions and their time-based draws on liquidities. As we can see, during the Asia session, there are no significant draws on liquidity. During the London session, our eye is drawn to the Asia high and low and to the previous day high and low. During the AM session, our eye is drawn to the London high and low, to the Asia high and low, and to the previous day high and low. During lunch, we usually sit on our hands, and during the PM session, our focus is drawn to the lunch high and low, to the AM high and low, to the London high and low, to the Asia high and low, and to the previous day high and low. As you may notice, there are 5 boxes, 5 significant time windows that I look at. The reason why there are 5 significant time windows has to do with the following. I try to look at sessions purely, but within the sessions themselves, I divide the sessions into 3 parts, and that's something that we will discuss during today's lecture more in depth, why I like to do that. Before we begin with looking at the sessions, I must first share an important note with you, and that's the following. We will discuss delivery profiles. Each scenario has its own characteristics. Our job is to determine what scenario is likely to occur. This does not mean that every single day there will be a profile that we would be able to engage in, and that's okay because not every single day is a trading day. Later on, within the model series, we will discuss environment selection more, and then we can basically already see when those profiles that we will discuss today will likely occur and when not. And the days on which they are likely to occur, we need to, of course, be present. That's when our shop is open. That's when we allow customers, which are setups, to enter the store, and we can either treat them in the right way or we can let go of them and just ignore them and don't service them. These delivery profiles do not occur every single day, and therefore you cannot force their occurrence. You need to wait and see whether or not the signatures that we'll be discussing today are present on the day that you're looking at if you are looking for setups to form. So let us take a look at the scenarios within the London session. First of all, the main question that we will be asking ourselves if we take a look at London is the following. What has Asia done? The first model that we will be discussing in a bit is the Asia High, Purge and Revert model. After that, we will take a look at the previous day High, Purge and Revert model. Then we will discuss the Asia Expansion model for shorts. Then we will take a look at the Asia Low, Purge and Revert model. After that, we will take a look at the previous day low, purge and revert model. And then finally, we will take a look at the Asia expansion model for longs. So let's take a look at the Asia high, purge and revert model. For the Asia high, purge and revert model, we will be looking at the following. We will be looking at, first of all, a market that is predetermined to go lower. So from the higher time frames, we have established that the market is likely to draw lower towards a sell side objective, a key liquidity pool, or to an old imbalance that price is likely to revisit. When we know that, and we have seen that Asia consolidated, then what we will look for is for a run higher around 2 a.m. towards the Asia high, and above the Asia high, we want to see the signatures occur that we have been discussing during the model series. So for example, the left side of the curve, their respective discount arrays get violated, or a lower time frame breaker setup forms, market structure shift pattern, change in the state of delivery occurs after the Asia high gets purged. During what time? During 2:30 to 4. If no reversal occurs during 2:30 or 4, I would walk away from the London session. From there on, I want to see displacement to the downside occur and I want to see sell side delivery occur. What would be the first drawn liquidity? The first drawn liquidity would be the Asia low and secondly, that higher time frame objective that price is likely to draw towards. The second model that we will be looking for during the London session is the previous day high purge and revert model. This model again occurs when the higher time frame order flow is bearish and we're looking for lower prices. What we will be looking for is a run higher to originate from around 2 a.m. and from there on we want to see the market draw towards the previous day high. When the previous day high gets traded above, we will be looking for signs to confirm a smart money reversal during 2:30 to 4. During this time window, we want to see a high form above the previous day high, and we want to see a change in the state of delivery occur on the lower time frames. From there on, we want to see displacement lower occur, which confirms that sell side delivery is likely to be next. This is a rather simple model that can be spotted quite easily when we take a look at previous day highs and how London trades above them. This scenario sets up a classic sell day in which London creates the high of the day, it expands lower, AM retraces and then continues the London trend towards that higher time frame objective. The next model that we will be looking at is the Asia expansion model for shorts. This model sets up when Asia is an expansion leg lower, so that means during the Asia session we saw speed and velocity to the downside. Then from the midnight opening or around the midnight opening, we want to see a retracement occur into an imbalance that formed during the Asia session. This run higher traps retail buyers into believing that higher prices are likely to be next during the London session. The market reprices into that inefficiency. A lower time frame market makers sell models smart money reversal forms inside of that CB. And from there on, we want to see sell side delivery occur. This model again occurs when the higher time frame order flow is bearish and price is drawn to a higher time frame sell side or inefficiency objective. This retracement leg usually forms the high of the day for the market to then continue lower, and this model occurs within fast markets. Again, we want to see the high form between 2:30 to 4 a.m. The next few models that we will be looking at for the London session are the same models but then for longs. So what we're going to look for is for a Asia low purge and revert model, in which we want to see that Asia has engineered liquidity on both sides of the marketplace. And from there on, we want to see that around 2 a.m. a manipulation run lower occurs, purging the sell side liquidity below the Asia low. A smart money reversal forms here during 2:30 to 4. And from there on, we want to see that the market shows a willingness to trade back above the Asia low and show lower time frame change in the state of delivery signatures to continue price higher towards the Asia high. This model sets up when the higher time frame order flow is bullish and the market is drawn towards buy side liquidity or to an all-in efficiency. You might be wondering, Zeus, why are you putting emphasis on around the 2 a.m. window? Because around 2 a.m., you will usually see a volatility injection during the London session. That volatility injection can be utilized for manipulation purposes. If there is a news event during the London session at a specific time, that news event is released could also be utilized for that final manipulation leg towards the point of interest, which is the Asia low, from which a smart morning reversal can occur to reprice higher. Now we're going to take a look at the previous day low purge and revert model, where we see that around 2 a.m. a manipulation leg begins, market draws towards the previous day low. The moment that the previous day low gets dispersed during 2:30 to 4, we're looking for signs of a smart money reversal occurring below that low. And from there on, we want to see price trade back above the previous day low to confirm a lower time frame change in the state of delivery. And from there on, we want to see a buy program unfold towards the previous day high if the higher time frame order flow is bullish. The next model will be that Asia expansion model, but now through longs. This model occurs when we see an expansion leg during the Asia session. We want to see a manipulation leg lower originate from the midnight opening, and then we want to see price trade into a imbalance that formed during Asia in a discount during 2:30 to 4 a.m., where we will be looking for a lower time frame smart money reversal to occur from to target buy side liquidity next. The buy side liquidity that we will be targeting is above, first of all, this high and the buy side liquidity that was engineered in the past where the market is drawing towards. This retracement into that Asia imbalance usually sets up the low of the day, and this occurs during very bullish market environments, and this is the first step to seeing whether or not a classic buy day is likely to unfold, where London forms the low of the day, and we can then look for buys during the AM session as well if the higher time frame objective has not been met just yet. What's important to note is that what I shared with you so far with regards to the London session is rather simple. It's rather basic when it comes to determining point of interest and what to look out for. And the reason why I'm keeping it simple for the London session is because of the following. London has a characteristic where if you are looking at index futures, its respective 90-minute cycles delivery are not that clean compared to the AM and PM session. If you are looking at London for example, EU or GU, then you will notice that what you will be able to do is that when you have established that a higher time frame POI is, for example, a BC that formed during Asia, you will notice that during the first 90-minute cycles of London, which is 2:30 to 4, you will see that if you fractalize that 90-minute cycle to 30-minute windows, where you have 2:30 to 3, 3 to 3:30, 3:30 to 4, you will notice that if 2:30 to 3 doesn't yet trade into that imbalance, 3 to 3:30 will form the low, and from there on 3:30 to 4 will confirm the smart money reversal. This is something for you to look into, and when we discuss the 90-minute cycles more in depth during the AM session in a bit, it will be more clear to you to how to apply this logic. So to finalize the schematic that we've been discussing so far during the past few lectures, we have the following schematic, where if we are bullish, we are looking for the following. We are looking for sell side delivery to occur into a point of interest, into a discount array or a PXL, for example, previous session low, specifically the Asia session low or the previous day low, during 2:30 to 4. And from there on, we want to see buy side delivery next if the higher time frame order flow is bullish. It's important to note that time cycles, they shift. So that means that you should be flexible when it comes to, for example, saying, okay, I want to see it specifically occur during 2:30 to 3 or 3 to 3:30. That's why I've given you a 90-minute window to look out for. When we take a look at the bearish example, we are looking at the following. We are looking for repricing higher into a point of interest, into a premium array and PXH during 2:30 to 4 a.m. Again, this occurs when the higher time frame order flow is bearish, and we want to see a smart money reversal occur within that point of interest during the right time, and then we want to see sell side delivery occur next. So to summarize, here are the times of interest for the London session. During 2:30 to 4 a.m., I want to see a smart money reversal form. If no reversal is present during this time window, I will walk away from the London session. I need to see an expansion leg during 3:30 to 4 a.m. towards the targets. If, for example, the smart money reversal occurs at 2:45 a.m., I don't anticipate the market to go sideways until 3:30 a.m. I want to see it begin to expand from at least 3 a.m. on. So that was the London session. My focus as a trader is mainly on the AM and PM session, so it's time to go deep into time during those sessions. First of all, we're going to begin with the regular trading hours. The regular trading hours are from 9:30 to 4 p.m. Often a gap will form between the closing price of the previous day and the opening of the new day. This is called the regular trading hours gap or the RTH gap. Price will seek to reprice back into this gap to rebalance it before expanding. This information is useful because if we know that there's an RTH gap present, then we can anticipate price to trade back into that gap or reprice into that gap to rebalance that inefficiency before expanding and continuing the real order flow. So let us begin with the 9:30 opening. The 9:30 opening is for me the most important opening price of the whole day. The reason why this is the most important price for me is because this is the open or the beginning of the regular trading hours. And we will always see a volatility injection during the 9:30 time window. If we take a look at why we are looking at the 9:30 opening specifically, we will be looking for the following. If we are bullish, we want to buy below or in close proximity to the 9:30 opening price. If we're bearish, we want to sell above or in close proximity to the 9:30 opening price. The 9:30 opening price is, in my opinion, the most important reference point that we can have on our charts throughout the whole trading day during the regular trading hours. Before the 9:30 opening, we can of course trade. There are still algorithmic signatures present. However, the 9:30 opening is a very important confluence for me when it comes to determining high probability setups. If we are looking at how 9:30 can deliver, we can look at the following. We will be looking at 9:30 opening profiles. It's important to note that these profiles are again scenarios that could occur. If they do not show signs of occurring on the day, I will walk away. We ideally want to see 9:30 create a false run against our narrative, against our analysis on where the market is likely to draw towards, and form a smart money reversal afterwards. This false run engineers liquidity and traps traders that fell for that manipulation. So this is what it looks like. On the left side, we can see what occurs if we're bullish. We can see that the market is trading lower and then pre-9:30 a low gets engineered right here. And from the 9:30 opening, the market completely rips lower. This repricing lower is the final manipulation leg before buy-side delivery comes next. The reason why this is so important is because every retail-minded trader will look at this manipulation leg lower and they will think to themselves, well, we have seen a 9:30 opening that was so bearish, therefore today is likely to be a bearish day. They are purely looking at this, they are not looking at narrative, they are not looking at where's the market like to draw towards, they are simply looking at the price pattern that forms here for them. People that buy or sell on a breakout will sell below this low, and what do? We buy those sell stops. And from there on, we see buy side delivery occur next because the higher time frame order flow is bullish. For the bearish example, we can see the following. We can see that pre 9:30 a high gets formed right here. Market then retraces. During 9:30, a run on the buy side liquidity above that high originates, and we can see that after that high gets purged, a higher high forms and the market begins the real sell side delivery program. Again, the reason why it secures is because of the following. From the 9:30 opening, they will reprice it higher and people will chase that. They will buy that because they see big green candles on that charts. Especially when those people are purely looking at the 9 or at the regular trading hours. So the 9:30 opening is the first time that a candle begins to print on their charts. And you would be surprised how many people just look at the regular trading hours. So what they see is that from here on, they see opco candles, opco candles, opco candles, opco candles, opco candles, and then out of nowhere it begins to turn. They are surprised why that happens, but they are already in their long position. And if they do not cut their trade when the market shows that it's forming a high here, they will get stopped out, or they will not even get stopped out and their account will be blown. We do not care about what those people do because we are purely focused on ourselves. When we look at this, we need to recognize that there are people that are making that mistake, and that's our enemy, that's our target, that's the opposing liquidity on our trades. So when we see that manipulation run higher towards the high that formed pre 9:30 into our point of interest, because that's important to note. Our point of interest is here, and for the buy model, our point of interest is here. When we see that occur, we will be ruthless and we will wait for our signatures to confirm that this is the high, and from there on sell side delivery is likely to be next towards our higher time frame draw on the liquidity. This is what the manipulation looks like within the buy model, and this is what the manipulation looks like within the sell model. The gray boxes represent this. Another 9:30 opening profile is the following. If 9:30 trades in our anticipated direction, we want to see a fake high or low form and then rip against our direction. This will be a false move before the real smart money reversal forms. Let me show you a schematic to explain what I mean by this description. This false run engineers liquidity again. What we see is the following. We are bullish on the marketplace. From 9:30 on, we see that the market rips higher and it forms a high. Again, what does every retail minded trader think when they see that? They want to buy that market. And what occurs afterwards is that sell side delivery occurs and the market gets repriced below the sell side liquidity that was engineered from the 9:30 opening. Why was sell side liquidity engineered? Remember everyone that was purely looking at the regular trading hours and tried to buy this from the 9:30 opening? They placed a stop below that opening price. So the market purchased that sell side liquidity, forms the smart money reversal inside of a point of interest, and from there on the real delivery occurs towards higher prices. For the bearish example, it looks like this. We see that the market trades higher. From 9:30 it begins to rip lower. Everyone goes short. What does the market do? Or what occurs? It gets repriced higher, purging the buy side liquidity that got engineered above this high, and then the real move occurs. Again, what I want you to note is how I'm looking at manipulation from that very specific time. That's so important to understand and note. This is what the manipulation looks like. If bullish, this whole leg higher is the manipulation leg. And if bearish, this is the whole manipulation leg from the 9:30 opening. But you could even argue that the real manipulation is everything above the opening price. And that's a valid argument as well. But what I'm showcasing here to you is that multiple manipulation legs follow after another. If you truly believe that the market is driven by algorithms, looking at the markets from this perspective will make every single market move logical to you, and you would never be surprised anymore why the market did what it did. Because if you look close enough, you will always see the logic that I'm sharing here with you occur, no matter what. This does not mean that you will be profitable trading these concepts. I cannot guarantee you profitability. I am purely sharing with you my own opinions on the marketplace. And again, this is in accordance with the terms of services and the risk disclaimer that you have agreed upon when joining my mentorship and subscribing to the platform. So the smart money reversal occurs below that 930 opening price, and this orange box represents that. If bullish, and if bearish, this orange box represents the smart money reversal within that sell model. We'll now be looking at the morning session scenarios. First of all, the main question that we will ask ourselves is the following. What have Asia and London done thus far throughout the trading day? The first model that we will be looking at is a London high purge and revert model. Secondly, we will be looking at the Asia high purge and revert model. And thirdly, we will be looking at the previous day high purge and revert model. We will also be looking at the London low purge and revert model. We will be looking at the Asia low purge and revert model. And we will be looking at the previous day low purge and revert model. And finally, we will be looking at the London expansion models. So first of all, we're going to take a look at the London high purge and revert model. This model occurs when we have seen that the London was going sideways or was consolidating, I should say. We then see that the market begins to trade higher. We want to see that around 8:30 a.m. a leg higher begins, a run higher. 8:30 is a very important opening time during the AM session, and we will discuss in a bit why this is an important opening time. It is also an important opening time, by the way, because a lot of high impact news usually originates or gets released around 8:30. What we want to see is that the market begins to trade higher into that buy side liquidity above the London high. We want to see that price level gets traded above during 9:30 to 10:30. For the viewers that are paying attention, they will notice that for the AM session, we have 1 hour for our point of interest to be reached, whilst for the London session, we had 90 minutes. And that's what I mean with saying that AM and PM are more precise time-wise than the London session when it comes specifically to the index futures. So between this time window, we want to see the market trade above the previous day high, and we want to see a smart money reversal occur from there. We then want to see displacement to the downside, and from there on we want to see sell side delivery occur next. This model occurs when the higher time frame order flow is bearish and the market is drawn to a key sell side objective or hold inefficiency. The next model that we will be looking at is the Asia high purge and revert model. This model occurs when Asia was a consolidation, London was an expansion away from that original consolidation, and we see that around 8:30 a run higher begins towards that Asia high. This run higher is the buy side of the curve within a market maker sell model. We want to see the market trade above that Asia high during 9:30 to 10:30, and we then want to see signs of a smart money reversal originate from there. From there on, we want to see displacement to the downside, and from there on, we can anticipate that the market will draw towards the London low and the higher time frame sell side objective and inefficiency if the higher time frame order flow is bearish. And it's important to note that everything lies around determining drawing liquidity and knowing the higher time frame order flow. And that's why I shared with you that if you did not understand those topics just yet, this lecture should not be watched. Because unless you understand those things, these delivery profiles will not do you any good so far. So let us take a look at the next schematic. The next schematic is a previous day high purge and revert model. This model occurs when we see that Asia was a consolidation, London takes out both sides of Asia, and we then see that around 8:30 the market begins to reprice higher towards previous day high. We want to see this high get reached during 9:30 to 10:30, and we want to see a smart money reversal occur above that previous day high, and we want to see signs of a change in state of delivery occurring to target sell side liquidity below the London low and below all of the other significant sell side pool liquidity pools. This model is fairly straightforward, just like the others. We're now going to take a look at the London expansion model for shorts. This model occurs when we are in a very bearish market and the market is drawn to a key sell side objective. We then see a expansion leg during London, which leaves behind an inefficiency, a CB to be precise. Around 8:30, we want to see a retracement occur into that CB, and between 9:30 to 10:30, we want to see that CB get reached, and from there on, we want to see a lower time frame market maker sell model get confirmed to target the sell side liquidity below this low and draw towards the higher time frame objective. Let us now take a look at the bullish examples. First of all, we're going to take a look at the London low purge and revert model. We want to see that around 8:30 the market begins to reprice lower into the London low, and we want to see a smart money reversal occur below that London low between 9:30 to 10:30. When the market then displaces to the upside and trades back above the London low, we will see our bullish breaker formation here, and we can then anticipate higher prices to be next if the higher time frame order flow is bullish and the market is drawn to buy side liquidity or an old inefficiency, especially in the form of a CB. If we're taking a look at the Asia low purge and revert model, it looks like the following. Asia was consolidation, London expanded to the upside, but did not continue higher. Instead, the market retraced lower, and from 8:30 we want to see sell side delivery occur. We want to see manipulation to the downside occur. Where could the market potentially reverse? Below the Asia low. We want to see the Asia low get reached between 9:30 to 10:30, and we will be looking for signs of a smart money reversal occurring below there during that time window. And if we see that order flow is shifting bullish intraday, we will first be targeting the London high, and after that the higher time frame objective that we are targeting. And then another model is the previous day low purge and revert model, where Asia was consolidation, London took out both sides of Asia, and then we see that around 8:30 the market begins to sell off again. Into what? Into the previous day low, and then between 9:30 to 10:30 we want to see that previous day low gets taken. We want to see a purge of that occur, and we want to see displacement to the upside occur. When that displacement occurs and we have taken out the sell side liquidity, we want to see the market draw towards the buy side liquidity above the London high and the liquidity resting higher. And the final model for longs during the AM session is the London expansion model, where we see an expansion leg during London that leaves behind an imbalance. Then between 8:30 to 10, yep, 8:30 to 10 specifically, we want to see a retracement occur. We will discuss this soon, why, but we want to see that BC gets reached between 9:30 to 10:30. We want to see a low time frame smart money reversal occur, and we will be targeting buy side liquidity resting above this high and higher. This model again occurs when we are in a fairly bullish market and the market is in close proximity to the higher time frame objective. So let us divide the morning session in 90 minutes now. First of all, 7 to 8:30 is the accumulation phase. This is the first 90-minute cycle of the morning session. This cycle is referred to as AM1, the first cycle of the AM session. The second cycle is 8:30 to 10. This is the manipulation cycle. This cycle is referred to as AM2. The third cycle is 10 to 11:30. This is the distribution cycle. This cycle is referred to as AM3. So what we have is that we have accumulation, manipulation, distribution. 7 to 11:30 AM is my AM session. That's how I look at the AM session. And we will now take a look at this AM session through the lens of these 90 minutes. We will now look at the AM session through the lens of 90 minutes. First of all, we are looking at the following scenario in which a purge of the first AM cycle's high, AM1H, and referred model occurs. The second model will be a purge of the second AM cycle's high and a referred model. The third scenario will be a purge of both the AM cycle 1 as the AM cycle 2 highs and referred model. We will then be looking at the purge of the AM cycles 1 low and referred model, and we will then be looking at a purge of the AM cycle 2 low and referred model, and finally we will be looking at a purge of the AM cycle 1 and AM cycle 2 their lows and referred model. It doesn't take long if you start putting in the work in your own charts after getting introduced to this theory to see the validity behind this theory. So let us take a look at the schematics. The first scenario is a purge of the AM cycles 1, his respective high, and a referred model. The AM cycle 1 is between 7 to 8:30. This is the accumulation phase of the AM session. We can see that the market is consolidating. Buy-side liquidity is being engineered above those highs. Then during the second 90-minute cycle, between 8:30 to 10, we can see that the market trades above that previous cycle's high and it reverts lower. It displaces to the downside. Then between 10 to 11:30, the market distributes quickly lower. What is occurring right here inside of this consolidation? Inside of this consolidation, orders are being accumulated. That means that smart money that have very deep pockets, that have a lot of money, they accumulate shorts here. They then manipulate higher to short once more to trap buyers, to trap retail buyers to be precise, into believing that the market is going to go higher. They buy this on a breakout and they try to capture a run higher, whilst smart money is opening more shorts here. This is the manipulation phase. And then distribution occurs and the market begins to sell off because the higher time frame order flow is bearish. So to summarize this scenario, we see a run on the high that forms between 7 to 8:30 during 8:30 to 10, and this sets up the highest price of the AM session, of the morning session, and then the market begins to fall and it distributes going into lunch at 11:30. The second model is the following. This is a model in which, or a scenario slash profile, in which there's a purge of the AM too high and a revert occurs. This occurs when the accumulation cycle has went sideways, the manipulation cycle took out the previous cycle's high, so the high of the accumulation cycle, but it did not displace to the downside yet. Why not? Because usually there is a high impact news driver at 10 AM that will be used for repricing and manipulation purposes. So what they do is they hold the markets sideways, are going sideways between 8:30 to 10. And then at 10 a.m., that high impact news driver gets utilized to send price higher once more, trapping buyers into believing that it's going to go higher. Buys at liquidity gets taken out here. Smart money sells short against that, and the market begins to roll over quickly during the distribution 90-minute cycle between 10 to 11:30. And then finally, the third scenario that we will be looking at is a purge of both the AM1 high as the AM2 high and referred model. So what we are seeing is the following. We're seeing that both the accumulation cycle as the manipulation cycle were going sideways. Why does this occur? Again, due to a high impact news driver being later on within the AM session, or no high impact news driver at all, and the market just being held inside of a consolidation until a volatility injection at 9:30. What we see is that the market gets repriced higher above these equal highs, above that buy side liquidity. A high forms above there, and the market then begins to distribute quickly. What I want you to take away from this is the following. You might have looked at these schematics and thought, what is he discussing? What is he sharing? I am sharing to you algorithmic reference points without even having to look at the London session or the Asia session. I'm purely looking at 90-minute cycles here. And I don't need to know that, or I don't even have to look at my chart to know that in here a higher time frame POI gets reached during this 90-minute cycle and a high forms inside that POI and the market begins to fall over because time and price are meeting. At the right point in time, a smart money reversal is occurring at the right price. Alright, so now we're going to take a look at the AM long scenarios. The first long scenario is a purge of the first AM cycle's low and a revert should occur after that. This occurs when the first AM cycle has been a consolidation, when the market went sideways, then at 8:30 the market begins to run lower, purging a sell side liquidity below 7 to 8:30, below that first AM cycle. Smart money buys down here. This is where the low of AM forms, and the market then reverses and it shows a willingness to deliver higher. Then between 10 to 11:30 the market will distribute higher very rapidly. This scenario usually unfolds when there's a high impact news driver at 8:30 that gets used for manipulation purposes inside of a very bullish market. If we take a look at the second AM scenario, we can see the following. We can see that this is a purge of the second AM cycle's low, and the market then reverts higher. This occurs when between 7 to 8:30 the market has been delivering lower, then during 8:30 to 10 the market continues this sell side delivery, so the market is drawn lower. Why is it drawing lower? Because on a higher time frame, it is retracing into a point of interest. Think back to the market maker lecture where I shared with you that the higher time frame retracement is a lower time frame sell side of the curve within a buy model that will be followed by a right side of the curve higher if the market is going to continue to be bullish. So what we see is that between 8:30 to 10, the market begins to deliver lower, but notice that between 8:30 to 10, a low gets engineered, the market retraces, and it then continues lower. It's vital here that at 10 a.m. the market is not yet below this low, so below the low of 8:30 to 10, because we want to see a final manipulation leg occur at or around 10 a.m. to create a new AM low during the 10 to 11:30 window. Once this low is in, the market will displace to the upside and will then reprice higher aggressively because it's within the distribution 90-minute macro. So this is the purge of the second AM cycle's low and revert model. And I'm now going to answer a question that some of you might have already been asking yourselves. And that's the following. But Zeus, how do I know which model is going to unfold? First of all, you look at the characteristics of what are these cycles doing this far. Are they consolidating or are they expanding aggressively? Secondly, you should wonder, or you should ask yourself the following. What is the point of interest where price is likely to trade into and continue from with the real institutional order flow? So if we're bullish, we want to have determined a discount array that could be utilized for a smart money reversal to originate in within a fractal market maker buy model. And we then want to see a previous cycle's low get engineered right above that point of interest, because that previous cycle low is engineering sell side liquidity inside of the point of interest. And it's funny because all the buyers that are buying during that previous cycle and are placing their stops below that previous cycle low, below that low that gets engineered, do not know that below them a real institutional price level is laying that will be utilized to originate a reversal from. They are buying it too soon. And that's how these markets are programmed and engineered. They engineer liquidity right before key market reversal points. When we see that occur and we see that Persian liquidity, it's the most sweetest thing you can see. So let us now take a look at the final delivery cycle scenario for the AM session. This is a purge of both the AM first cycle's low and the second AM cycle's low. This occurs when during the first AM cycle the market has been trading inside of a range, then towards the end it reprices lower, forming a low, but it immediately reprices higher back into the range. Then during 8:30 to 10 the market creates a higher high relative to the previous cycle's high, and it then falls lower. But notice that equal lows are being engineered right here. This is the engineering of sell-side liquidity, but not just any sell-side liquidity. No, it's engineering of 2 cycles worth of liquidity. So during the final AM cycle, during the third AM cycle, 10 to 11:30, there's a significant reference point and liquidity point that can be targeted for manipulation purposes. So when we see these relatively equal lows get engineered and the market shows a willingness to manipulate below that, this is the sweetest purge that we can look for. And when we then see the displacement occur, it is likely to reprice higher very quickly. Again, this scenario occurs when there's high impact news around the end of the AM session, so around 9:45 to 10 AM, or when there's no high impact news at all and 9:30 is the main volatility driver for the AM session. It's important to note that all these scenarios that have been shared with you only occur throughout the day when there are obvious higher time frame, institutional order flow, either bullish or bearish present. If they're not, we can't go into the lower time frames and look for these signatures. We simply can't, because then we will get caught up in chop. Because if the market goes sideways, if it consolidates, if it goes into a seek and destroy profile, that's not something we like. And again, later during the mentorship and during this model series, I will share with you key insights on environment selection and how we can recognize these models and these scenarios likely not playing out. Because knowing when not to look for these scenarios is more important than knowing what they look like. To summarize, here are the time of interest for the AM session. During 9:30 to 10:30 AM, I want to see a smart money reversal form. I preferably want to see signs of a reversal between 9:50 to 10:10. The reason why I preferably want to see signs of a reversal between that time window is because that time window is a 20-minute macro. This macro has the characteristic of introducing or injecting speed and velocity into the marketplace, and therefore we want to see a reversal occur during that time window. If no reversal is present during the full hour window, so between 9:30 to 10:30, I will walk away from the charts and I will go on with my personal life. Because I know when the sweetest setups form and when they don't. And if a reversal is not occurring between this time window, then that means to me that, okay, we're likely to see either continuation of chop or we're going to see a late AM session reversal that I am not interested in. I would rather come back during the PM session, during the afternoon session, and see if there's something to trade then. I need to see an expansion during at least 10:30 to 11:30 towards the targets. If, for example, the smart money reversal occurs at 9:45 a.m., I don't anticipate the market to go sideways until 10:30. I want to see it begin to expand from 9:50 to 10:10 on. So here is the final schematic of the schematic that has been shared with you ever since the first release of the first lecture of the market maker buy model, where we can see the sell side of the curve into a point of interest, and this point of interest has to get reached during 9:30 to 10:30. This point of interest is a discount array and the PXL. From there on, we want to see a smart money reversal occur, and on the lower time frames, this looks like a market maker buy model. For the sell side delivery, we can see the following profile, in which a market maker sell model occurs, where the market reprices higher into a premium array or PXH. This is our point of interest, and this point of interest has to get reached during 9:30 to 10:30. This is our time of interest for the AM session. We want to see a smart money reversal occur on the lower time frames right here, and from there on the sell side of the curve. Let us now take a look at the afternoon or PM session. The main question that we will ask ourselves is the following. What have the morning and lunch session done? You will notice that I look at lunch as the first part of the PM session. I will share more on this in a bit. The first model that we will discuss is a purge of the lunch high and revert model. The lunch cycle by itself is already the first cycle for the PM session. The second model that we will be looking at is a purge of the AM and lunch high to revert model. We will then be looking at a purge of the lunch low or the first PM cycle slow and revert model. And we will also look at a purge of both the AM and lunch low and revert model. Let us now take a look at the PM session through the lens of 90 minutes. The first 90-minute window of the PM session is the 11:30 to 1 PM window. This is the accumulation phase of the PM session. This is also what we call lunch. The second 90-minute cycle for the PM session is from 1 PM to 2:30 PM. This is our manipulation window. Then the third 90-minute cycle is from 2:30 PM to 4 PM. This is our distribution cycle. Let us take a look at the first scenario for PM. This is a purge of the lunch high and a revert scenario. This scenario unfolds when AM was an expansion lower. This is showcased by this red box. Lunch consolidated, engineered relatively equal lows relative to the AM cycle. And from there on, we see that lunch trades higher from the 1 PM opening. Why does it trade higher from the 1 PM opening? Because this manipulation leg higher towards the lunch high induces buyers into the marketplace. Every retail-minded trader will look at that leg higher and think that lunch is going to continue higher after AM expanded lower. So lunch would set up a reversal in their minds. We do not look at it that way because we know that the higher time frame order flow is bearish and that price is drawn towards a key sell side objective. Therefore, we are looking at this run higher as manipulation and we want to see a smart money reversal occur above the lunch high between 1:30 to 2:30 p.m. It's important to note that it is not required for AM and lunch to create relatively equal lows for this scenario to unfold. It is also possible that lunch could already take out the AM lows and that the market would then still trade above the lunch high and then reverse above there. All we are looking at currently is the relationship between the first PM cycle, which is the lunch cycle, and the second PM cycle, which is from 1 p.m. to 2:30 p.m. When that trades above the lunch high, we are looking for signs of a smart money reversal occurring above there if the higher time frame order flow is bearish. If we take a look at the following scenario, we can see a purge of the AM and lunch high followed by a revert. This occurs when the morning sessions high and the lunch sessions high are relatively equal, or if the morning sessions high was, for example, already taken out during the lunch cycle, then the first PM cycle will trade above the lunch cycle's high, purge the buy side liquidity above there during 1:30 to 2:30, and from there on form a smart money reversal to distribute lower if price is drawn towards a key sell side objective on the higher time frame. If we take a look at the bullish scenarios, we can see the following. This is the purge of the lunch low and revert scenario, in which the market sells off from the 1 p.m. opening right here. It retraces, then continues lower, purging liquidity below the lunch low, forms a fractal smart money reversal here between 1:30 to 2:30 p.m. and we see buy side delivery unfold, targeting the lunch high. This scenario unfolds when the higher time frame order flow is bullish and price is drawn towards a higher time frame price objective which is above the current market price. The function of the lunch cycle in both scenarios, by the way, is to engineer liquidity that can be targeted at a later point in time. Again, it is important to note that AM and lunch do not have to have created relatively equal highs for this scenario to play out. It is important, however, to note that AM should be an expansion leg higher and that lunch should be a consolidation or retracement into an imbalance from the AM session. So we have not only the liquidity that's important, the time-based liquidity that gets taken at the right point in time, but we also have the imbalance that gets traded into. And then the final scenario we're going to look at from these simple schematics is the following. Is a purge of the AM low and lunch low followed by a revert. Again, this occurs when the market has created either relatively equal lows during the morning session and during lunch, or that the lunch session already took out the morning's low, but relatively speaking, price is already below the morning low, so therefore we can anticipate that the market will try and seek the nearest possible key sell side liquidity, which is below the lunch low. And the moment it gets reached between 1:30 to 2:30 p.m., we will be looking for a smart money reversal to occur below that low, from which a market maker buy model can unfold if the higher time frame order flow is bullish. What I want you to take away from all of these schematics that I'm sharing with you is that I'm speaking in if this then that terms. All these schematics are only valid if it's clear that the market is either gonna go higher or lower. If it's not clear where the market is drawing towards, we will not be looking for these scenarios to play out. So let us now take a look through the lens of 90 minutes at the PM session. from a model perspective. So we've already taken a look at the first section here, which was a purge of the launch high and a revert model. This was, I believe, the first slide. Then the second bullet is the purge of the second PM sessions high and revert model. Third bullet is the purge of the first PM high and both the PM2 high, followed by a revert. The fourth bullet is a purge of the first PM cycle's low and revert model. This was again a previous slide. And then we have the purge of the second PM cycle's low and revert model. And finally, the purge of both the first as second PM session's low revert model. So here is the purge of the second PM cycle's high and revert model. This occurs when during launch a consolidation occurred, and then during the second 90-minute cycle, the market expands towards the launch cycle's high, takes it out, but then falls back into the consolidation and doesn't displace lower. What then usually occurs is that the market has one more run on buy side liquidity, originating around 2:30 p.m., taking out the previous cycle's high, and from there on we see a reversal originate, targeting sell side objective. It's important to note that this can also occur when the second PM cycle was an expansion leg higher and the third PM cycle is just an open manipulation, forms the high of that cycle and then immediately distributes the lower, taking out sell side. There are many variations to these delivery profiles. However, what is not something that can be changed a lot is what is written down here. Because if you have made it this far throughout the lecture, and if you have paid close attention, all this is about this sentence right here. Purge the second PM cycle's high and revert model. When should the second PM cycle's high be taken out? If price is bearish on the higher time frames during the third PM cycle. So we're looking at the previous cycle's high as a reference point to utilize going forward. For the long scenario during the PM session, we're going to take a look at a purge of the second PM cycle's low and revert model. This occurs when from the PM opening at 11:30 or during the lunch opening, the market is slowly trading lower than during the second 90-minute cycle's open, which occurs at 1 p.m. The market sells off rapidly. It sells off aggressively. This selling off from the 1 p.m. opening is a retracement on a higher time frame into a discount array. This retracement engineers buy-side liquidity by trapping retail shorters into believing that the market is going to go lower during the PM session. The market retraces, and at 2:30 a final run lower occurs into the low of the previous cycle, which got engineered right here. It is crucial that 2:30 does not open below this low just yet. We want to see 2:30 be utilized for the final manipulation lower into that previous cycle low, into that discount array that will be utilized for a fractal smart money reversal to occur from. And if this model is being followed, if this delivery profile is being followed, the right side of the curve is likely to be very aggressive because a lot of buy side liquidity has been engineered and the market has been going lower for a relatively long period of time in a rather slow manner, and therefore it is anticipated that the low resistance liquidity run can occur. Accumulation, manipulation, distribution. So let's take a look at another long scenario. It's the following. It's a purge of the first cycle low and the second cycle's low. This occurs when during the first two cycles of the PM session, relatively equal lows got engineered, whilst a higher high got created during the second cycle relative to the first cycle. What this does is the following. This market is consolidating from the opening. What then occurs is that sell side gets delivered, a low gets engineered, and the market trades back into the range. It does not displace. What then occurs is that the market manipulates to the upside because buy side liquidity got engineered during that consolidation. It then reverses and it seems to displace lower. But what's occurring is that the market is just again retracing into a higher time frame discount array from which a smart money reversal will occur from inside of a discount array inside of a market maker buy model if the higher time frame order flow is bullish, if the market is predetermined to go higher. And what we then see is that the buy side of the curve unfolds between 2:30 p.m. and 4 p.m. Again, it's important to note that these are delivery profiles, and that means that they occur on certain days within certain environments. This does not mean that every single scenario will play out every single day, because that's of course not possible. There's a switching that occurs of what profile will be followed on that very specific day. And our job is to determine what profile is likely to be followed for that current trading day. To summarize, here are the times of interest for the PM session. During 1:30 p.m. to 2:30 p.m., I want to see a smart money reversal form. I would preferably want to see signs of a reversal between 1:50 to 2:10 p.m. Again, this time window is a macro window in which I want to see speed and velocity be injected into the marketplace, and this can come in the form of quick sell side delivery followed by quick buy side delivery if bullish within a buy model, and if we are seeing quick buy side delivery followed by quick sell side delivery if bearish, so within a sell model. That's why I want to see signs of reversal between those times. Let's take a look at the next bullet point, which is that I need to see an expansion during 2:30 to 3:30 towards the targets. If, for example, the smart money reversal occurs at 1:45 p.m., I do not anticipate the market to go sideways all the way until 2:30 p.m. I want to see it begin to expand from 1:50 p.m. to 2:10. So from that macro time window that has been shared with you. So to finalize the simple schematic that has been shared with you, this is what it would look like for the PM session within bullish order flow within a market maker buy model. We want to see the sell side of the curve deliver into our point of interest, which is a discount array and or a previous X low during 1:30 p.m. to 2:30 p.m. We want to see a smart money reversal occur from there and see higher prices be delivered after that. And this is what it looks like for bearish order flow. This is our market maker sell model where we want to see buy side delivery get delivered into our point of interest, into our premium array or previous XH. During 1:30 to 2:30 p.m., we want to see signs of a smart money reversal occur from here and see sell side delivery be delivered afterwards. And here's my final note for you. And this is going to be a technical one, so please pay close attention. What I hope that you understand is that this very simple drawing of an arrow higher and arrow lower originating from a horizontal line here is me sharing with you that this is all one big sell model. All you need to know is that the original consolidation forms at a price level and that there's a price level where the market will draw towards and reverse from. Based on the original consolidation, this price level is already predetermined. So based on how the original consolidation delivered and how it got engineered, it is already predetermined how high the market will draw on the left side of the curve, aka the buy side of the curve, before it will turn around during our time of interest, if it's going to turn around. One of the ways that we can look at how we can determine this price level, this reversal point, is by utilizing projections based on the range of the original consolidation. So what we can do is that we can say, okay, we project standard deviations based on the low to high of the original consolidations and project into the future standard deviations. And whenever significant standard deviations get reached, we can anticipate a smart money reversal to occur. But that's not all. Based on the time that the lowest low forms here, we can already anticipate when the highest high is likely to form. Stuff for you to think about. So yes, this was all me explaining the market maker sell model to you in a very simplistic manner during the past 3 lectures. And of course, for the inverted chart, the market maker buy model. I want to give you some homework to end this lecture. I want you to go into your own charts and see the application of the 90-minute cycles and the logic I shared with you during the AM or PM session. If you want to apply the logic shared to the London session, I will share with you now how you can do so. What you can do is that you can divide the 90-minute cycles by 3. What you then get is for 1 90-minute cycles, you get 3 30-minute cycles. Since London is, in my opinion, not a favorable session to trade when it comes to the 90-minute cycles, the only way I would look at London from a scalper's perspective is by looking at 30-minute cycles and 30-minute AMD cycles. So within every single 90-minute cycle, you have again AMD that occurs. And within every single 30-minute cycle, you have again AMD that occurs into 10-minute cycles, and you can even fractalize that, and you can see how crazy it gets when you keep on fractalizing. But that's what is happening. Time and price are both fractal. But anyhow, if your focus is just on the AM and PM session, follow the logic that was shared during this lecture, and going forward I will share more insights on what I just shared, so don't worry about that. I want you to study how price relates to the previous cycle's high or low with regards to where, for example, smart money reversals occur. With this bullet point, I mean that you should put emphasis on the point of interest from which a smart money reversal occurs. Utilize these time cycles when you're looking at the AM and PM session. So note that, for example, a smart money reversal occurs at exactly 10:03. If a reversal occurs at exactly 10:03, below 8:30 to 10 slow and 7 to 8:30 slow, you note that down because that is crucial information. I will share with you how you will be able to log this better in the future. I will create a tutorial on how you should log this, because logging the data is the most important thing. For now, just try and make proper notes of where smart money reversals occur from, where the market is drawing towards after reversal occurs from, and that's how you can study the application of time through the lens that I shared it with you during this lecture. I want you to try and annotate at least 30 plus examples of market maker models utilizing this logic. What you often see is that during the AM and PM session, this logic can both be applied. It does not mean that the cleanest market maker models are present every single day during both sessions. Again, this logic only works and it only is applicable during very specific environments, or within very specific environments, I should say. And environment selection is crucial when it comes to determining when these things should work and when they shouldn't. So to conclude, this was a long lecture, so it is completely normal if you feel overwhelmed by everything that was shared with you during this lecture. We started off rather basic, but we quickly increased the level of difficulty, and the level of the difficulty is currently around midpoint. So it's around level 5 of a scale to level 1 to 10, and there's way more to dive into and to utilize. I want you to take your time with digesting the knowledge and re-watch this lecture in a while when you feel like you're ready to do so. The next lecture will be on the application of what has been shared so far within the model series and more insights on time and specifically time-based PD arrays will be shared. So I want to thank you for watching this lecture. I wish you a very nice day and I look forward to speaking to you in the next one.